9 out of 10 options traders are losing money right now. Not because the market is rigged, not because they're dumb, but because they are only playing the game one way. And I'm going to show you exactly what that means and the strategy that flips those odds completely upside down. Because here's what nobody in the options world wants to admit. The way most beginners are taught to trade options, it's practically designed to make you lose. Stick with me. By the end of this video, you're going to understand a trading structure that gives you defined risk, faster profits, less stress, and a win rate that most traders would absolutely not believe. And no, it's not some algorithm. It's not some secret hedge fund tool. It's a debit spread, and most people using it are using it completely wrong. Before I break down the strategy, I need to show you something that might sting a little. A SEB study, analyzing over 3 years of retail options trading, found that 93% of retail traders in the futures and options segment ended up losing money. 93%. And a study out of the University of Florida confirmed that retail traders lose money over 1 day, 2 day, and 3 day periods, consistently averaging a loss of more than 16% over just 3 days of holding. Let that sink in. Most traders are not just losing occasionally, they are losing systematically. And the biggest reason is painfully simple. They are trading only one direction at a time with zero protection. That's the roadblock, and that's exactly what we're going to fix today. Let's talk about how most traders start. They get approved for what's called Level 1 options trading. That means they can buy calls and buy puts. That's it, and there's nothing wrong with learning calls and puts first. But here's where the trap is. Most traders never leave Level 1 thinking. What does that mean? It means they are placing a bet, pure and simple, that a stock is going to go up or down within a specific window of time. Buy a call, hope the stock rips. Collect money. Buy a put, hope the stock tanks. Collect money. But what actually happens? The stock barely moves. Or it moves in the wrong direction for 3 days before it comes back. Or it moves exactly right, but theta, which is time decay, has already eaten 40% of your options value while you were waiting, and there is zero protection built into that trade. Zero cushion, zero defined exit, just pure hope. This is the Level 1 trap. You can be right about direction and still lose money. That is a broken system. Now, here's the thing, and this is where most videos stop. They say buying calls is risky. Don't do it, and that's it. But the real insight is this. It's not that directional trading is wrong, it's that trading without a defined structure is wrong. And that's exactly where debit spreads change everything. Now, before I explain how the debit spread works, I need to show you why the alternative most traders jump to next has a hidden flaw that almost nobody talks about. A lot of traders who graduate past buying naked calls and puts move into spreads. Good, that's the right move. But then they face a choice. Do I use a debit spread or a credit spread? And most people, especially when they start watching finance content online, get pushed toward credit spreads. And the pitch is seductive. Get paid to enter the trade, collect premium up front. Let time decay work for you. Make money even if the stock doesn't move. That sounds amazing, and credit spreads do have their place. I'm not here to say they're garbage, but I want to show you the structural difference that matters enormously for a specific type of trader. The active short duration trader who wants to stack consistent wins and compound capital fast. Here's the breakdown. A credit spread means you sell a closer to the money option and buy a further out of the money option for protection. You collect a net premium up front. Your job is for the stock to stay away from your short strike. You're essentially hoping for time to pass and for the stock not to move against you. A debit spread means you buy the closer to the money option and sell a further out of the money option to reduce your cost. You pay a small net premium. Your job is for the stock to move in your direction. You need a move, and when you get it, you win. Now, here's where most people get it wrong. They hear debit, meaning you're paying, and they think that's bad. They hear credit, meaning you're collecting, and they think that's good. But that framing misses everything. The debit spread has a structural edge in 4 specific ways. Number 1, capital efficiency. Because you're buying a spread instead of a naked option, you are dramatically reducing your cost. Instead of paying $500 for a call option, you might pay $80 for the same directional exposure. Your maximum loss is defined. It is the premium you paid. Period. End of sentence. Number 2, defined risk with no margin requirement. Credit spreads can expose you to assignment risk that requires margin. Debit spreads do not. You paid your premium. That is your maximum loss. There are no surprises, no margin calls, no waking up to a horror story because you got assigned overnight. Number 3, you benefit from movement, not just time. Credit spreads need the stock to stay still or drift in your favor. Debit spreads need the stock to make a meaningful move, and when that move happens, you can often reach 40 to 50% of maximum profit, incredibly fast. Sometimes within just a few days. Number 4, and this is the most important and the least talked about edge in all of spread trading: the ATR filter. This is the one thing that separates traders with a 50% win rate from traders with a 90% win rate. And almost nobody in the options world is talking about it. Most traders place a debit spread, and they never ask one question. Is my spread cushion bigger than this asset's typical price swing? Every asset, whether it's a stock, an ETF, a crypto product, has something called an average true range, the ATR. It measures how much that asset moves, on average, over a given time frame. Now think about this. You set up a debit spread with a $3 cushion between your strikes. The stock's monthly ATR is $7. You just put a $3 umbrella over a $7 storm. That is a bad trade, full stop. If the ATR of the asset is higher than the cushion of your spread, meaning the distance between your long strike and your short strike, the asset has the statistical range to blow right through your spread and hand you a max loss. The rule is simple. If the asset's monthly ATR is higher than your spread cushion, you skip the trade. You wait for a better setup, or you widen the spread to match. This one filter alone will eliminate a shocking percentage of losing trades from your playbook. I have watched hours of options content on YouTube. I read constantly. I pay attention to what traders are actually teaching. And I have never seen another options educator connect ATR to spread width as a trade qualifier. This is a legitimate edge. And now you have it. But here's where it gets even better. Because there is something about debit spreads that most traders treat as a problem. But if you understand it correctly, it is actually one of the best things that can happen to you. If you set up a debit spread and the stock moves aggressively in your direction, so aggressively that your short option goes deep in the money, there's a chance you get assigned early. Most traders panic when they hear that. They've read things like early assignment is a risk and be warned, and they treat it like a monster in the closet. I want to reframe this completely. Early assignment on a debit spread, when your position is already winning, is actually a gift. That's why. When both legs of your debit spread go deep in the money, the spread is worth its maximum value. The full width of the strikes, if you got assigned early on the short leg, it means the market has handed you the full profit of the trade ahead of schedule. And here is the critical point. That is faster than waiting for expiration. When you close a spread at or near max value, because both options are deep in the money, you've captured your win early. You don't sit around for 20 more days hoping nothing unravels. You free your capital, you recycle it, you go again. Think about it this way. You entered a debit call spread expecting the stock to move up. It moved up, aggressively. You're sitting on near max profit in 5 days. A lot of traders hesitate. They think maybe it goes even higher. But the smart move is simple. Close it, lock it in, move on. Time in the market is risk. Getting out early with full or near full profit removes that risk entirely. The only context where early assignment creates a brief headache is if you've already closed one leg of the spread and left the other open. But if you're managing your spread correctly and closing the whole position together, early assignment is simply a fast track to your profit target. It's not a problem. It's the trade doing exactly what you wanted, just faster. This next part is what I want you to actually write down, or pause and screenshot, or rewatch later, because this is the full system. I call it cash recycling, and it is the single biggest reason that active debit spread traders with a disciplined exit strategy outperform almost every other retail option strategy over time. Here's how it works. Step 1. Enter the trade. You identify a high probability directional setup. You run the ATR check. Your spread cushion is larger than the monthly ATR. The setup is clean. You enter a debit spread. Step 2. Set your exit at 40 to 50% profit. No negotiation. The moment your spread reaches 40 to 50% of its maximum potential profit, you close it. You don't wait. You don't negotiate with yourself. You don't sit there thinking, what if it goes higher? This is the rule. It is non-negotiable. Why 40 to 50%? Because that is the optimal zone where time decay hasn't had a chance to accelerate against you. Where assignment risk is low, where you've captured a meaningful portion of the trade's value, and where the risk-reward of continuing the trade starts to deteriorate. After 50% profit, you are taking on more risk for a smaller and smaller incremental reward. The math stops working in your favor. In a $3 wide spread that cost you $1, your max profit is $2. 40 to 50% of that is 80 cents to $1. You close it, you move on. Step 3. Recycle the capital immediately. Your $80 debit is now sitting in your account as $140 or $160 within 7 to 12 days. You identify the next setup, you run the ATR check, and you enter again. This is the compounding engine, not wait for expiration compounding, not slow grinding theta decay compounding. Active fast cycle compounding, 7 to 12 days per trade. 40 to 50% profits, rinse and repeat. Let me show you what this actually looks like. Start with $1,000. Run 2 trades per month. Average 40% return on each deployed position. Recycle capital after each close. By the end of month 1, that $1,000 has become close to $2,000. By the end of month 2, that's approaching $4,000. By month 3, you're north of $7,000. This is not a fantasy. This is the math of disciplined, fast cycle debit spread, trading with defined risk and consistent exits. Now, I want to be real with you. Not every trade hits 40 to 50%. Some close for less, some close at a small loss, but the defining characteristics of this system, short hold times, defined risk, disciplined exits, creates something almost no other strategy can claim, an unusually high win rate. Because we are holding these trades for 7 to 12 days, not until expiration. We are almost always in positions where the stock still has time to behave. We're not fighting zero-day theta. We're not holding through earnings uncertainty and hoping for a miracle. We're getting in, getting our move, and getting out. In practice, this 7 to 12-day active management approach produces win rates in the range of 90% on high-probability setups where the ATR filter passes 90%, not by magic, by structure, by discipline, by not overstaying your welcome in a position. Now, let me come back to the ATR filter and go deeper. Because this is the thing I genuinely believe separates people who are consistently profitable with debit spreads from people who wonder why their win rate is average. Average, true range, ATR, most traders know what it is. It's a volatility indicator that tells you how much an asset typically moves over a given period. But almost no one is using it to qualify spread trades. That is a mistake. Here is the mental model I want you to use every single time you consider a debit spread. Is my spread cushion wide enough to survive this asset's natural movement? Let's say you're looking at a stock trading at $50. You want to set up a bull call spread. You buy the $52 call and sell the $55 call. Your spread width is $3. Now you pull up the monthly ATR on that stock, it's $6. Stop. Do not enter this trade. Why? Because this asset moves an average of $6 in a month. Your spread is only $3 wide. The stock's natural range will eat through your spread under completely normal market conditions. You're betting on a precise, narrow move in a position that statistically doesn't have the cushion to handle the asset's typical behavior. That is a low probability bet disguised as a spread. Now flip the scenario. The monthly ATR is $2. Your $3 spread cushion is now larger than the typical monthly move. That is a trade worth taking. Your spread has a wider buffer than the asset's natural volatility. You have room to be slightly wrong on timing and still win. The rule: your spread cushion must be wider than the monthly ATR, or the trade has unfavorable structure by default. When you combine this ATR filter with the cash recycling system and the 40 to 50% exits, you are trading with structural advantages stacked in your favor on every single trade. You are no longer gambling, you are engineering outcomes. Let me give you the full picture one more time, clean and simple. Here is the complete system. 1. Skip the single leg trap. 90% of options traders fail because they are trading directionally with no structure and no protection. Level 1 thinking is a money-losing framework for anyone who stays in it long term. 2. Use debit spreads. They give you defined risk, no margin requirements, and fast profit potential when your directional thesis plays out. Capital efficiency that naked options simply don't have. 3. Run the ATR filter before every single trade. If the asset's monthly ATR is larger than your spread's cushion, skip the trade. Do not rationalize it. Do not talk yourself into it. Skip it. 4. Set your exit at 40 to 50%. Hard rule. Always, the temptation to squeeze more out of a winning trade is the single most common way. Disciplined traders become undisciplined traders. 40 to 50% and out. Every time. 5. Welcome early assignment. If both legs go deep in the money and you're sitting on max profit ahead of schedule, that is not a problem. That is the trade working perfectly. Close it and move on. 6. Recycle the capital immediately. Every dollar freed from a closed trade is a dollar working toward the next 40 to 50% gain. This is how the compounding accelerates. 7. Repeat in 7 to 12 days. Short cycles, high probability, defined risk, consistent exits. That is the engine. The people who follow this system are not the ones watching their account tick up and down. For 30 days, waiting for expiration, they're entering winning fast and doing it again and again and again. Look, I know there's a lot in this video, but the beautiful thing about this system is that it is not complicated once the rules are locked in. Defined risk, ATR filter. 40 to 50% exits, cash recycling, short hold times. That's it. That is the whole thing. If you're currently holding options, positions all the way to expiration and wondering why you keep leaving money on the table, or worse, giving it back, this is your answer. If you've been scared off by spreads because of early assignment, this video is your reframe. And if you've never used the ATR as a trade qualifier, this is the edge you've been missing. Drop a comment below and tell me this. What does your typical options trade look like right now? Are you still doing single-leg trades waiting for that one big win? Or are you already running spreads? I read every comment, and the answers I get in there usually turn into the next video. If this hit different, if something clicked, then join our free school community below, where we share one high probability debit credit spread trade every day and share it with one person you know who's been grinding and losing on naked options. It might actually change their account. See you in the next one.